Here's the question that sounds simple but isn't. What is business finance? Most of the people think it's about accounting, spreadsheet, maybe budgets. But that's not it. Finance is the language of decision making. Every choice a business makes, whether to hire someone, launch a product, open a new store, or even shut down, comes down to business finance. And if you don't understand this language, you are flying blind. By the end of this video, you will see business completely differently. Let's start from zero. So what is business finance? Here's the simplest definition I can give you. Business finance is how a company manages money, where it comes from, where it goes, and whether it's being used wisely. That's it. But let me break that down because each part matters. First, where money comes from. A business doesn't just magically have money. It either earns it from selling products or services, or borrows it from banks, or it raises it from investors who believe in the idea. Sometimes the owner just put in their own savings. The source of money is called financing. And this is critical because different sources come with different costs and risks. A loan has to be paid back with interest. An investor wants a share of future profits. Your own savings, well, that's the money you could have used elsewhere. Where money goes. Money flows out constantly. Salaries, rent, raw material, marketing, equipment, taxes. Some of those costs happens every month, those are fixed costs. Some only happens when you produce or sell something, those are variable costs. Understanding where your money goes tells you whether the business is efficient or wasteful. Third, whether money is being used wisely. That's the hardest part because it's not just about spending less, it's about spending smart. Should you invest 10 lakh rupees in a new machine? Should you hire 2 people or 1? Should you expand to a second city? Every decision is a trade-off, and finance gives you tools to make those trade-offs rational instead of emotional. Let me tell you something most people don't realize. Every business problem is secretly a finance problem. You think marketing is about creativity? Sure. But if your customer's acquisition cost is higher than your customer's lifetime value, you're bleeding money. You think operations is about logistics? Absolutely. But if your inventory is stuck for months, you have locked up cash that could have been used elsewhere. You think HR is about hiring the right people? Of course. But if your payroll is 70% of the revenue and revenue isn't growing, you have a structural problem. Finance connects everything. It's the central nervous system of the business. Without it, you can't see if you're healthy or sick. You can't predict if you'll survive next quarter. You can't decide if the opportunity is worth chasing. Think about it like this. Imagine you are driving a car at night without headlights. You can still drive, but you can't see where you are going and how fast you are moving and what's ahead. That is business without finance. Finance is the dashboard, the headlights, and the GPS all in one. It tells you where you are going, and whether you will get there. Now, let's get more structured. Business finance rests on 3 pillars. Pillar 1, capital structure. This is about where your money comes from. Every business needs money to start and grow. You can fund it with equity, money from your owners or investors, or you can fund it with debt, loan from banks or bonds. Or you can use retained earnings, which are the profit you have saved over time. Each choice has consequences. Equity means you are giving up ownership. Debt means you have to pay interest even in bad years. Retained earning means you are limited by how much you have already earned. The mix of these sources is called your capital structure, and it quietly determines your risk, flexibility, and cost of money. Pillar 2. Investment decision. Once you have money, you have to deploy it. Should you buy a machinery, hire people, open a new location, invest in R&D, research and development? These are called capital budgeting decisions. And these capital budgeting decisions are irreversible. If you build a factory and it doesn't work out, you can't just undo it. You have locked in lakhs or crores. That's why investment decision needs financial analysis, not gut feeling. You need to ask, will this generate more value than it costs? We'll cover tools like NPV, IRR, and payback period in the future videos. But the principle is simple. Invest in the things that create more value than they consume. Pillar 3, working capital management. This is the day-to-day money flow. Inventory, receivables, payables, cash in the bank. You might be profitable on paper, but if your customers haven't paid yet and suppliers are demanding payment, you are in trouble. That's called a cash flow crisis, and it kills more businesses than the losses do. Because profit is an accounting concept. Cash is survival. Working capital management is about making sure you always have enough liquidity to operate. These 3 pillars, capital structure, investment decision, and working capital, form the foundation of business finance. Master this and you are ahead of 90% of entrepreneurs. Let me clear up a common confusion. Finance is not accounting. Accounting records, which is what happened. Finance decides what should happen next. Accounting tells you we made 5 lakh rupees profit last month. Finance asks should we reinvest that 5 lakh rupees, save it or distribute it. Accounting is backward looking, finance is forward looking. Both are essential, but they serve different purposes. Accounting gives you the data, finance gives you the decisions framework. Think of accounting as scoreboard, finance as strategy. You need both to win. So what's the ultimate goal of business finance? Here's the answer that most textbooks give you. Maximize shareholders' wealth. And that's technically correct, but let me give you a more complete picture. The real goal is to create value sustainably. Value for shareholders, yes, but also for customers, employees, suppliers, and society. Because business that ignores stakeholders eventually collapse. Finance is about making trade-offs, short-term profit versus long-term growth, risk versus return, expansion versus stability. The best financial decision balances all of these. They don't chase profit blindly, they build resilient, adaptable, valuable businesses. Okay, so that's what business finance really is. It's not just numbers on a spreadsheet. It's the logic behind every business decision. Where money comes from, where it goes, whether it's being used wisely. In the next video, we'll talk about financial goals, because not all businesses chase profit in the same way. Some prioritizes growth, some prioritizes survival, some prioritizes cash flow. Understanding why businesses make financial choices is just as important as understanding how. If you found this helpful, hit like, subscribe if you want to build serious financial fluency, and I'll see you in the next one.